Imagine staring down the barrel of like a 60-year career.
Yeah, that's a really long time.
Right. And that is not a typo.
Yeah.
6 full decades of, waking up, commuting, putting in the hours. Because according to the latest demographic data, if you're listening to this right now, there's a very good chance you'll live to be 100 years old.
Which is wild to think about.
It really is. Anyway, welcome to NovaStream. I'm your host, and we are streaming 24/7 to bring you real-time updates across the live crypto markets, global financial indices, and the breaking news feed.
And I'm glad to be here to break it all down with you.
Definitely. So today we're diving into the highlights of the day, and we are looking at this massive convergence of events that honestly all tie back to a single theme.
Yeah, we're watching a global economy that's basically caught in a brutal tug of war.
Yeah, tug of war. Okay, how so?
Well, on one side, we have these profound structural disruptions. I mean, everything from geopolitical choke points to those severe demographic shifts you just mentioned.
Mm-hmm.
And then pulling back on the other side, you have this aggressive technological and a financial adaptation. People are trying to solve or at least engineer a way around all those physical limits.
Yeah, that makes sense. So let's start with those structural limits by checking the global financial indices, because we're seeing major banks run the numbers on what this tug of war looks like if, things actually snap.
Oh, yeah. The stress tests.
Right. HSBC just released a stress test for 2026, and they're modeling what they call their darkest scenario.
Which is never a fun phrase to read in a banking report.
Yeah, no, not at all. They're projecting a situation where ongoing conflicts in the Middle East escalate enough to trigger like a 35% collapse in global stock markets.
Yeah.
And get this, oil spiking to $145 a barrel.
Yeah, and a spike like that, I mean, it drags down global growth universally.
This is tied to everything, right?
Precisely. Every supply chain, every piece of manufacturing, it all relies on energy. When energy costs that much, inflation just tears through the entire system.
But here's the thing about those doomsday models. You don't actually need a hypothetical 35% market crash in 2026 to feel the burn.
No, you really don't.
The underlying pressure they're modeling is already quietly hitting your wallet right now. If you walk into a grocery store today, you are experiencing a silent crisis.
Yeah, everyone feels it at the checkout line.
We keep talking about inflation cooling down, but the reality on the ground is that grocery prices are still 25 to 30% higher than they were pre-2020.
And it really comes down to the mechanics of input costs. Like, if you want to understand why your cereal is so expensive, you actually have to look at fertilizer.
Fertilizer? Wait, really?
Yeah, fertilizer costs have hit new 2026 highs this year. And the main driver there is the shipping disruption through the Strait of Hormuz.
Okay, but we normally associate that region entirely with crude oil, don't we?
We do, but roughly 30% of the world's fertilizer passes through that exact same choke point.
Oh, wow. I had no idea. So it's basically this massive Jenga tower. You pull the shipping lane block, which pulls the fertilizer block, which pulls the agricultural block, and suddenly the entire grocery bill collapses onto the consumer.
That is a really solid way to visualize it. When fertilizer gets stuck in transit, it gets scarce. And when it's scarce, it gets incredibly expensive.
Right, supply and demand?
Yeah, and that forces U.S. farmers to make harsh economic choices. They're actually cutting back on planting crops that require heavy fertilization.
Like corn. Right.
Precisely. And less corn planted in the U.S. means a smaller global grain supply, which raises the baseline cost of almost all food production.
And farmers aren't the only ones adjusting. I mean, we're seeing trade tariffs inflating the cost of imported goods like Brazilian coffee and sugar.
Oh, yeah. The tariffs add up quickly.
Plus, manufacturers are relying heavily on shrinkflation. They keep the price on the box of cereal the same, but they just quietly shave off a few ounces of the product inside.
Which is incredibly frustrating for shoppers.
It is. Add to that the U.S. national debt acting as this, hidden inflation tax, constantly eroding the actual purchasing power of the dollars in your checking account. It's like a slow leak in a car tire.
They're slowly, yeah.
You don't notice it immediately, but your engine is working harder, burning more fuel, and eventually, you're stranded on the side of the road.
It's compounding pressure from every side. In fact, a recent United Nations report warns that if these specific geopolitical disruptions continue at this pace, we could easily see another 15 to 20% rise in the cost of basic food products by the end of 2026.
Which naturally leads people to wonder if someone is artificially tilting the scales.
Right, the corporate side of things.
Yeah. We know there are physical supply chain issues, but there's a massive domestic probe happening right now into the meat industry to see if corporate consolidation is making things worse.
Let's pivot to the meat counter, yeah.
Ground beef is averaging about $6.70 a pound right now, which is up 16%.
Hmm.
And the Department of Justice just officially stepped in.
They did. The DOJ launched a criminal antitrust probe into the big four beef packers.
That's Tyson, Cargill, JBS, and National Beef, right?
That's them. And to understand why this is a federal issue, you really have to look at the market share. Those four companies control roughly 85% of the entire U.S. beef processing market.
Wait, 85%. So four boardrooms basically dictate the price of almost all the beef in the country.
Essentially, yes. And the DOJ is investigating potential price fixing and collusion, specifically regarding how these giants buy cattle from independent ranchers.
So what are they alleging exactly? I mean, specifically.
The core of the investigation is whether these companies are coordinating to restrict the supply of processed beef, keeping prices artificially high for consumers, while simultaneously refusing to pay ranchers fair market value for their cattle.
Ah, so it's a squeeze from both ends.
Yeah, and the DOJ is taking this incredibly seriously. They're actively offering financial rewards for whistleblowers. They're specifically trying to pull insider information that could lead to corporate penalties exceeding $1 million.
Wow. They're not messing around.
Not at all. And this follows closely on the heels of the DOJ settling with a data company called AgriStats. The allegation there was that meat companies were using shared, highly sensitive data to coordinate and restrict supply.
But, the ranchers themselves are also dealing with massive physical constraints, right? It's not just corporate middlemen rigging the game.
Right. The ranchers are caught in a structural nightmare. Due to years of severe droughts out west, U.S. cattle herds have actually shrunk to a 75-year low.
75 years? That's insane.
Yeah, ranchers simply haven't had the water or pasture availability to sustain their animals, which forces massive sell-offs. So you have record low cattle supply, historically high consumer demand, and a concentrated processing market allegedly exploiting the gap.
So while the government is using antitrust probes to fight inflation at the grocery store, they're actually using a completely counterintuitive strategy to fight inflation at the gas pump.
The oil export.
Yeah. The U.S. is currently exporting American oil at record levels to combat high domestic energy costs. And I have to admit, I struggle with the logic here. If we want cheaper gas at home, why wouldn't we just, keep all the oil we drill right here?
It seems entirely backward, I agree.
Yeah.
Until you look at the physical properties of the oil we produce versus the machinery, we have to refine it.
Okay, break that down for me.
So the U.S. pumps millions of barrels of oil from shale formations. That oil is classified as light sweet crude. But our massive refinery infrastructure, especially along the Gulf Coast, was built decades ago. It was custom engineered to process heavy, sour crude.
Which we historically imported, right?
Yeah, from places like Venezuela or the Middle East.
Okay, hold on. So it's a structural mismatch. It's like growing a ton of apples, realizing you only have recipes for oranges, so you flood the farmer's market with your apples to drive the overall price of fruit down so you can afford to buy oranges.
That is a very practical way to look at it, actually. Because our refineries can't efficiently process all the light, sweet crude we drill. We export it.
Okay.
And by doing so, the United States acts as the global barrel of last resort. We flood the international market with massive supply. That puts huge downward pressure on global pricing benchmarks, like Brent crude.
And because the price I pay at my local gas pump is tied directly to those global benchmarks, driving down the international price is literally the only way to drive down my domestic cost.
Spot on. It's an incredible logistical workaround to keep domestic inflation in check without having to rebuild billions of dollars in refinery infrastructure.
That is fascinating.
Yeah.
Well, let's shift from physical constraints to the companies trying to engineer their way around them. Looking at the equities markets, UBS just put out a report stating that large-cap stocks are heavily positioned to beat small-cap stocks.
Let's break down the mechanics of why that shift is happening.
Yeah, so a large cap refers to massive established companies with a high market capitalization, think Apple or Microsoft.
Right.
And small caps are smaller, often newer companies. UBS is pointing out that in the current economic climate, small caps are hurting.
They generally rely much more heavily on floating rate debt to fund their operations. With anticipated interest rate cuts fading, that debt stays really expensive.
Meanwhile, the large caps are just sitting on mountains of cash.
Yeah, they have stronger earnings quality, and crucially, they're the only ones with the immediate capital to reap the massive returns from deploying AI infrastructure. UBS also notes that international diversification is paying off heavily for these larger companies as the U.S. dollar weakens.
Checking our corporate maneuver updates, Elon Musk just got handed a $1.5 million SEC settlement.
Bit of a slap on the wrist for him.
Yeah, pretty much. It's essentially a penalty for failing to timely disclose his initial 5% share acquisition of Twitter before he ultimately bought the whole platform for $44 billion.
Interesting timing on that.
Right. On a much brighter note for tech, PayPal is seeing a massive rally. They had a back-to-fundamentals first quarter, boasting $464 billion in payment volume.
That is a huge number.
But the real story is how they achieved it. It was a massive $1.5 billion cost-cutting plan, stripping out the bloat to make those payment volumes actually profitable.
We're also watching a massive logistical war unfold right now. Amazon is taking direct aim at the entire transport sector by launching Amazon Supply Chain Services.
Yeah, they aren't just delivering their own packages anymore.
No, they're opening up their massive fulfillment and delivery network to other businesses. Analysts are actually calling it the AWS of logistics.
Just like Amazon Web Services revolutionized cloud computing by renting out their excess server space, they're trying to revolutionize shipping by renting out their excess delivery trucks.
And the market understood the threat instantly.
Oh yeah, FedEx shares dropped 9% on the news, and UPS sank over 10%. But out of all the tech earnings crossing the NovaStream feed today, Palantir is the standout. They posted $1.63 billion in Q1 revenue. That's up 85% year over year. It's their fastest growth ever as a public company. Their U.S. commercial revenue alone surged 133%.
What stands out to me isn't just the raw numbers, but the commentary from Palantir's leadership. CEO Alex Karp and CTO Shyam Sankar went on the offensive, targeting what they call AI slop.
AI slop. Okay, what are they referring to there?
They're describing the rush of low-value, hyperbolic AI applications flooding the enterprise market. Karp argues that competitors are selling commodity cognition, basically generic, off-the-shelf AI tools that don't solve specific business problems.
So just fluff, basically.
Yeah, and instead they just create massive security vulnerabilities and generate useless, repetitive outputs.
So companies are buying the shiny new toy without knowing how to integrate it. It's like an AI fast food binge.
A fast food binge, I like that.
Yeah, everyone is gorging on cheap, easily accessible AI tokens just to tell their shareholders they have an AI strategy, but they end up bloated with this slop. While Palantir is trying to sell the enterprise equivalent of a, highly nutritious, secure meal plan.
And CTO Shyam Sankar actually used a classic economic theory to explain why this slop is happening, the Jevons paradox.
Walk us through how that paradox works.
Sure. So the Jevons paradox occurs when a technology becomes more efficient and therefore cheaper to use. You would logically think that greater efficiency means we consume less of that resource.
Right.
But historically, the exact opposite happens. As it gets cheaper, we find so many new uses for it that overall demand absolutely skyrockets.
So as AI inference gets cheaper to run, companies don't just optimize their current tasks, they run millions more queries. They burn through vastly more tokens simply because they can, which just generates mountains of this low-value slop.
That's the crux of Palantir's pitch. They claim their artificial intelligence platform, or AIP, is the only no-slop zone. They're selling the infrastructure to actually secure and manage that massive scale of computation, so it drives tangible operational value instead of just burning capital.
Wow. Okay, so all of this corporate restructuring, the logistics wars, the DOJ probes, none of it happens in a vacuum.
Right, it's all connected.
The rules of the road for Amazon, Palantir, and the domestic beef supply are all written in Washington. So let's pull up the NovaStream breaking news feed and look at the upcoming May and June primary elections. We aren't just looking at names on a ballot, we're looking at how hyper-local procedural quirks dictate global policy.
The local mechanics of these races are really fascinating. Take Nebraska's 2nd District primary on May 12th. Republican Representative Don Bagan is retiring a district that Kamala Harris won in 2024.
Okay.
And the Democratic primary between Denise Powell and John Kavanaugh is carrying huge national weight right now.
Because this is all about the blue dot, right?
Yes. Nebraska is unique because it awards its electoral votes by congressional district rather than winner-take-all. If Kavanaugh wins this primary, political operatives argue there's a convoluted path where the Republican governor might appoint Kavanaugh's replacement in the state Senate.
Oh, I see where this is going.
Right. That single appointment could give Republicans the legislative majority they need to change Nebraska's laws to winner-take-all.
Meaning one local primary could literally erase a critical Democratic electoral vote in a presidential race. It's the butterfly effect in action, how highly localized procedural rules end up shifting the balance of power in Washington.
Exactly.
And we're also seeing a massive tug of war for the soul of the Republican Party in these primaries, testing the strength of Donald Trump's endorsements. Look at Kentucky's 4th District on May 19th. Representative Thomas Massie, who pushed for the release of the Epstein files and voted against GOP leadership, faces Ed Gulrain.
And Gail Rain has Trump's endorsement, right?
Yes, and Trump has even publicly targeted Massie's wife in the crossfire, so it's incredibly tense.
You see a similar dynamic in Ohio's 9th District on May 5th. Democratic Representative Marcy Kaptur, who managed to hold her seat in 2024 despite Trump carrying the district, is facing a rematch against Republican Derek Merrin.
And Marin is currently battling through a crowded primary of fresh faces to secure that nomination.
Yeah. And out in Montana's 1st District on June 2nd, Republican Representative Ryan Zinkas is retiring. The GOP primary to replace him is highly contentious, featuring Trump-backed Aaron Flint running against Olszewski.
Which is interesting because Zinke has heavily attacked Olszewski in the past, and the Democrats have a populist, Sam Forstag, running against Ryan Buss there, too.
The Democrats have their own internal friction across the board. Look at Pennsylvania's 7th District on May 19th.
Right. Bob Brooks versus Ryan Crosswell to take on GOP Representative Ryan McKenzie.
Yeah, Brooks is facing intense backlash over past right-wing social media posts, and Crosswell is actively comparing him to John Fetterman.
And in California's 22nd, on June 2nd, you have a classic moderate versus progressive battle between Jasmeet Bains and Randy Villegas to see who takes on the formidable Republican incumbent, David Valadao.
It really illustrates how the macro environment, tariffs, antitrust actions, energy policy, ultimately traces back to factional disputes and procedural maneuvering at the county and state levels.
Absolutely. And when you have local politics constantly threatening to upend global trade and fiat currencies bleeding out through the hidden inflation taxes we discussed earlier, well, capital naturally looks for an escape hatch.
Which brings us to crypto.
Yes. Checking our live crypto markets, Bitcoin has officially broken out.
It's a really significant move. Bitcoin reclaimed the $80,000 level for the first time since late January. And this isn't just retail trader hype. The rally is built on massive structural support, specifically spot ETF inflows.
Break down what those inflows actually mean for the market.
Well, a spot ETF allows traditional investors to buy shares that track the real-time price of Bitcoin without having to manage a crypto wallet themselves. Giant asset managers like BlackRock and Fidelity have packaged Bitcoin for standard retirement and brokerage accounts.
Making it super accessible.
Yeah. Since those launched in January 2024, we've seen a cumulative net inflow of nearly $59.6 billion.
That is massive institutional capital acting as a floor for the asset. And we're also seeing reports that short covering is acting as rocket fuel for this breakout.
Short covering, yeah.
For those unfamiliar, short covering happens when traders bet that the price of an asset is going to drop. When the price unexpectedly rises instead, those traders are forced to buy the asset to cover their losing bets, which paradoxically drives the price even higher.
That dynamic is in full effect right now, and it's aided by easing macro tensions in the Middle East, reducing some market anxiety.
But looking at the technical levels on the dynamic sparkline charts, there is still risk. Resistance is sitting between $84,000 and $88,000.
And the support levels.
The support level absolutely needs to hold at the $78,000 to $79,000 range. If Bitcoin drops below $75,000, analysts are warning it might just be a bull trap.
A bull trap. That's essentially a false signal. A declining asset temporarily spikes upward, tricking investors into buying in right before the asset resumes its downward crash, trapping everyone who bought the peak.
Ouch.
So holding those support levels is critical. And we should note, traditional finance is fully adopting digital assets across the board. HSBC, the same bank modeling that doomsday scenario for 2026, just launched a tokenized gold product on a blockchain that has already seen $1 billion in trading volume.
$1 billion. Wow. Which brings us full circle to the ultimate question. We track these crypto cycles, we stress over the price of ground beef, we monitor AI token burn. Why the obsession with building long-term wealth?
Because long-term means something entirely different today.
It does. According to the Stanford Center on Longevity, a 100-year lifespan will become the standard norm by the year 2050.
The demographic shift is just rewriting the rules of human existence. The United Nations is projecting 25 million centenarians worldwide by 2100.
Let that sink in for a second. 25 million people living past 100. Which brings us back to that 60-year career we opened with. You can't retire at 65 if you have 35 more years of groceries to buy at inflated prices.
You really can't.
It fills me with this weird mix of awe and dread. I mean, if you have to fund a century on Earth, a massive 4-year crypto cycle or a decade-long AI boom isn't your entire financial life anymore. It's just a footnote on a much longer timeline.
It forces a complete recalibration of how you view risk, how you approach compound interest, and how you value your own human capital. The 60-year career completely rewrites the rules of investing.
That wraps up the sheer scale of our highlights of the day. We've navigated the hidden inflation at the checkout line, the logistical paradox of American oil exports, Palantir's corporate war on AI slop, the hyperlocal political primaries shaping global policy, and a massive Bitcoin breakout fueled by institutional capital.
And I want to leave you with a final thought that combines two of our biggest stories today. We discussed tech giants racing to fully automate cognitive labor with AI. At the exact same time, human life expectancy is rising to demand a 60-year career.
Right.
If artificial intelligence successfully automates all that knowledge work, what will humans actually be doing for those 6 decades of work?
That is a fascinating, slightly terrifying question we're all going to have to answer very soon. Thank you so much for tuning into this segment. Remember, NovaStream is live 24/7, bringing you the data the second it breaks. Have a great day, and we'll see you next time.